Continue now our week-long series on heavy metals. It has been a wild year for gold, up over 20% since last May, with many all-time highs hit along the way. We want to take a look now at the role that exchange-traded funds, ETFs, have played in gold's climb. The biggest gold ETF is the Spider Gold Trust, trading as GLD. They're also the sixth largest holder of gold in the world. Tom Anderson helps run the fund as the head of global ETF strategy at State Street. Welcome, Tom, to the show. Thanks for joining us.
Thank you.
Let me ask, first of all, what role you think ETFs have played in commodities trading in general, because they've kind of gotten a bad name in the press.
Yeah, there certainly have been questions about the role that ETFs have in price changes for physically based commodity ETFs. You know, the example I use for gold that I think is pretty illustrative is if you look at 2009, ETF demand represented about half of total gold investment demand. It was only 25% of total gold demand in 2010. So investment demand for gold has been very strong, but in 2010 it was really driven by investors who wanted physical gold, whether in the form of coins or in the form of smaller gold bars.
You know, I guess, Tom, whenever we're talking to somebody, who's running an ETF, I guess the question that we like to pose is, why an ETF, especially in this case, versus the physical gold? I mean, why? What's really the advantages here?
Well, for a physical gold ETF like GLD, it really comes down to simplicity and convenience. So, if you're an investor, you can either choose to, buy GLD on your online brokerage account or through your financial advisor, or you can figure out where to go buy physical gold in the form of coins or bars, store that gold for as long as you want, find some place to sell it, so it's a much more cumbersome, difficult transaction. GLD and the other gold ETFs have really just added simplicity and an awful lot of liquidity to this process for investors.
What do you think? I mean, when we talk to big gold bugs like Mark Faber, for example, he says all the time that he gives speeches to huge audiences of hedge fund managers, and less than 5% of them actually hold gold. We hear from gold bugs that it's not widely held. Do you think that's the case?
Well, I think gold is held quite widely, but the amount of holdings has actually been getting wider every year. There are a number of hedge funds with very major positions in GLD and other gold ETFs. So what we've noticed is that over the last several years, since 2004, when GLD was launched, the depth of those holdings and the breadth of those holdings for hedge funds as well as other institutional investors keeps getting broader and broader.
Tom, let me ask you, because let me go back to what you said about, why an ETF versus owning the actual commodity itself. And you talk about the ease, convenience of not having to actually go out and get the physical bar. I mean, but by you guys, essentially investing that way, I mean, how much are you really driving the price of gold?
Well, as I said before, it's been quite interesting. There have been years where, if you look at just investment demand, I mean, this has been interesting. Investment demand for gold, and investment demand includes both ETFs as well as, physical coins and smaller bars. That demand continues to get higher, year over year. The ETF proportion of that demand was much higher in 2009, much lower in 2010. So what we would argue is that investment demand certainly could be affecting the price of gold, but ETFs are only a small part of that total investment demand.
So bottom line, you don't think it's a big factor?
We don't think so.
What do you make of COMEX boosting requirements, margin requirements for silver? Obviously, this is a futures trade, but it affected commodities across the board. Do you think they're going to do that for other commodities beyond? Oil was recently hit, but not nearly as hard as silver, and only one time.
It's so hard to say. I mean, I think our point would be we've certainly observed the fall in the price of a number of commodities. Gold was affected not as much as many of the other commodities, but GLD holds physical gold bullion, not futures contracts, so GLD should not be affected by this.
Although it's still, obviously, it was a move on the futures, but it obviously affects the physical commodity price as well. Do you think COMEX is trying to discourage people from being long these commodities?
That's really not something I could speculate on. Sorry.
Got it. Well, thanks so much for joining us. In any case, Tom Anderson there from State Street. We are going